Good evening and thanks for joining us. The top stories today. The main US indexes are up a little again today. We caught up with Lance Roberts at Real Investment Advice to see why he's taken some of his chips off the table. A payroll tax cut may be on the way. The president wants it, but there is some opposition. We have the details. A new report says global real estate investment dropped massively in the first half of 2020, but other sectors are expected to outperform. And some large companies are handing out bonuses prior to filing for bankruptcy. They may be taking advantage of a loophole in the legal system. Wall Street gained ground on Monday as surging technology shares pushed the Nasdaq to a record closing high. Another one. The tech sector in the S&P 500 also enjoyed large gains, as well as with consumer discretionary stocks. The Dow rose nearly 9 points, or 0.03%. The S&P 500 gained 27 points, or 0.84%, and the Nasdaq added nearly 264 points, or 2.51%. Look at that Nasdaq go. With the major indexes staying in the green, I wanted to catch up with Lance Roberts to see why he's sold some of his equity shares recently. Here's what he had to say. Lance, thanks for coming on.
Absolutely, glad to be here.
Lance, we've seen again the markets have continued the rally a little bit today, and I've read recently you've taken some of your chips off the table. You felt it's a good time to do that. Why exactly was that?
Well, for instance, if you look at the market today, it's a very narrow rally. It's primarily Amazon, Microsoft, Apple, and of course Adobe, and some of the kind of the stay-at-home stocks like CRM software. But primarily, if you look at the rest of the market, lots of red in the market today. Advancers and decliners are being outweighed by the number of down stocks. So this isn't typically the type of healthy market that you want to be participating in. But we had written back in January and February of this year the same exact article. We're taking some money off the table just to reduce some of our risks to the markets. That doesn't mean we sold everything, right? We just simply reduced some of our position sizes, took some profits off the table, and that protected us during the downturn in March. We're doing the same thing now for a couple of reasons. One, the markets are very extended here. We've had a big run from the March lows. Things are getting very pricey on a valuation basis. Earnings are starting to come in. They're not really all that good, and that could potentially weigh on markets a little bit later on. But also, as we get into August and September, those tend to be about the 60 weakest days of the year, and we're running into a the pre-election campaign. Whether or not we're going to stimulus bill pass, that's getting talked about today, but there's going to be lots of arguing over that issue over the next couple of weeks. And we've got this rising number of cases in terms of the virus, which is about to collide with the start of our seasonal flu period. So now people are going to be sick with the flu thinking they have COVID-19, and you can just imagine what kind of mess develops from that. So for all those reasons, we're kind of just reducing some of our risk. We're still long the markets, and we have a lot of exposure to the markets right now, but we hedge our exposure as we go just to manage our risk.
And on these concentrated rallies you've spoken about, I've seen some analysts and commentators compare it to the dot-com bubble and warning people it could be similar to the dot-com bubble. Yeah. Is it different now that the Fed is involved, or not necessarily?
Well, the three most dangerous words, in investing is "this time is different," and I guess that's actually four, but you get the point. But there is a lot of concentration, and the reason this gets compared a lot back to the dot-com crisis or the dot-com bubble peak is because you saw a lot of the same action: people running in, overpaying for earnings, overpaying for valuations. Scott McNealy is a good example of this. He was the CEO of Sun Micro back in 1999, 2000. He said in an interview with Bloomberg, he said, "You're paying 10 times sales for my stock." He says, "What are you thinking?" He says, I can't grow my company fast enough to ever justify that valuation." Well, you've got stocks today like Paycom and NVIDIA and others that are trading at 20 times price to sales. So that's where a lot of the comparisons come from. Investors are way overpaying for earnings. These companies, no matter how good you think they are, they cannot grow earnings fast enough to justify those valuations over the next decade, much less over the next year or two.
And I met up with a friend of mine for a coffee yesterday. He's a stay-at-home trader. And he said something that kind of, set some alarm bells off in my mind. Maybe I'd like to get your thoughts on it. He said that he feels at the moment that as long as the Fed is in the game, he feels there's no downside risk for himself. And he feels that the way he put it to me was, it feels like I'm just printing money by putting my money into listed companies. What are your thoughts on that?
Well, look, I've been through the crash of '87. I went through the crash in '99. I went through the crash in 2007. And I'll tell you, there's one similarity to each one of those. We saw this in '99 in particular. Day trading firms were popping up everywhere. People were literally printing money out of the markets, chasing every kind of .com stock there was. Whenever people become overly confident in markets, that's typically a contrarian sign to the markets near term and longer term as well. And the reason for that is that overconfidence breeds exuberance, which ultimately breeds fatality within markets in terms of trading. And investors are clinging to the hope that the Federal Reserve liquidity will continue to support markets. But over the course of the last decade, it's taking more and more and more quantitative easing to generate the same amount of returns out of stocks. In 2009, it took about $1.60 of QE to generate $1 worth of return in the market. It now takes almost $2.50 to generate the same dollar of return. And there is a limit to what the Fed can do. So that effectiveness of the Fed liquidity is being absorbed by the markets. And that's a very dangerous situation ultimately for overconfidence investors to be banking on one thing to support their thesis.
I'll make sure to send him your insights, Lance. I'm sure he'll appreciate it. Lance, thanks so much as always.
My pleasure.
The pandemic is disrupting real estate deals around the world. Savills says investment fell by 33% in the first half of 2020. The Asia-Pacific region took the biggest hit. It's down 45% from a year earlier. Investment dropped by 36% in the Americas, and it dropped 19% in Europe, the Middle East, and Africa. Savills says investors are now just waiting for market clarity. Investment is expected to stay well below pre-pandemic levels for the rest of the year, and investors are now focusing on secure assets and other sectors like logistics and residential. They're expected to outperform. And the Senate is back in session today, and stimulus negotiations are starting back. It could be the last major push in federal funding in the aftermath of the virus.
White House Chief of Staff Mark Meadows says stimulus negotiations are starting in earnest. He said Republican leaders in Congress will meet with President Trump and Treasury Secretary Mnuchin to fine-tune details. It sets up the possibility of another round of stimulus checks, small business safeguards, and expanded unemployment insurance. Congress has a tight deadline to negotiate. The next break starts in early August, and the extra $600 per week in unemployment insurance ends this month. Republicans have said they want to end the expanded unemployment payments. They say it's a disincentive to work. Democrats are pushing to keep the extra benefits until early next year. Meadows said the bill will likely be over $1 trillion. The previous CARES Act cost $2.2 trillion. The House Democrats' HEROES Act would cost over $3 trillion. Earlier this month, Senate Majority Leader Mitch McConnell suggested the next direct payments should be sent to low-income Americans. The president also said he wants to see more direct checks to Americans, but with bigger payments than what Democrats suggested. Last week, House Speaker Nancy Pelosi said she believes Republicans will agree with the Democrats' proposal. Specifics of the Republican proposed bill are expected to be revealed later this week.
President Trump says he wants to see a payroll tax cut in the bill. He says if it's missing, he might not sign it.
President Trump said the next COVID-19 relief bill must contain payroll tax cut provisions. Otherwise, he may refuse to sign it into law. Trump made the remarks on Sunday's interview with Chris Wallace on Fox News. Wallace also asked Trump about liability protection for businesses and other entities resuming operations amid the pandemic. Trump said we do need protections because businesses are going to get sued just because someone walked in. You don't know where this virus comes from. They'll sit down at a restaurant. They'll sue the restaurant. The guy's out of business. The battle in Congress over the new COVID-19 aid bill began on Friday as Republicans put the finishing touches on draft provisions. Senate Majority Leader Mitch McConnell provided a draft to Reuters. It shows Republicans are looking to grant liability protections to a wide range of entities, including government agencies, schools, colleges, and businesses. The draft shows that the liability protections would sunset at the end of a federal COVID-19 emergency declaration or 2024, whichever comes later. McConnell also said he hopes the next bill will not cost more than $1 trillion, but leading Democrats have vowed to fight for more, somewhere in the range of $3 trillion.
There is some opposition to the bill, mostly from Democrats, but from some Republicans too. We caught up with Tom Ozimek earlier for the latest. Tom, thanks for coming on. I believe there's some opposition to the payroll tax cut proposition. Is that right?
There is indeed, Paul. Well, the chief objection is that payroll tax cut does little or nothing to benefit people who are unemployed. But by reducing employers' payroll expenses, it does encourage them to hire people, and therefore does address the unemployment issue. Another objection is that by lowering Social Security revenues, it would jeopardize benefits to seniors. But one solution that's been proposed are government bonds into the Social Security Administration. This is a solution that was done under the Bush and Obama administrations when they implemented a temporary payroll tax cut.
And do you think it's something they're going to be able to resolve between themselves, or?
Well, President Trump has come out very forcefully in insisting that he wouldn't sign a bill unless it contains provisions for a payroll tax cut, and he suggested that he also wants some form of liability protections for businesses that are, and not just businesses, but a host of entities that are coming back online after amid the pandemic. Well, my sense is that history has shown that when there's opposition around these types of issues, the end result is that more ends up in the bill, and the bills end up being more expensive than initially anticipated for.
We'll keep an eye on it, Tom. Thanks so much.
Thanks, Paul.
It's been revealed that many companies paid out big executive bonuses less than a month before filing for bankruptcy. One company paid a whopping $6 million to one individual.
Reuters reviewed financial disclosures and court records from 45 companies that filed for bankruptcy between March 11th to July 15th. This period starts from the day the WHO declared the virus outbreak a pandemic. Reuters reviewed companies with public trade or debt stock and more than $50 million in liabilities. Of the 45 large companies that filed for bankruptcy, nearly a third of them paid out executive bonuses within a month before doing so. Only 6 of the 14 companies that approved bonuses within a month of their filings cited pandemic-related compensation. Under bankruptcy law, companies are largely banned from paying executives retention bonuses while in bankruptcy. But the company seized on a loophole by granting payouts before filing. On May 10th, American retailer JCPenney's board approved compensation that paid top executives nearly $10 million. CEO Jill Soltau received more than $6 million of that. The company declined to comment for this story, but said in an earlier statement that the bonuses aimed to retain a talented management team that had made progress on a turnaround before the pandemic. The other companies declined to comment or did not respond. In filings, many said economic turmoil had rendered traditional compensation plans obsolete, or that the bonuses forfeited other compensation. Some specialists argue the bonuses are hard to justify for executives who may have few better job options in an economic crisis.
Steve Mnuchin says the government should consider forgiving all small PPP loans. Currently, loan recipients have to apply to have loans forgiven, but small business advocates say the process is too long and complicated.
U.S. Treasury Secretary Steven Mnuchin says the government should consider forgiving all small loans under the Paycheck Protection Program. He said fraud protection would be needed. This comes after over 100 groups sent a letter to lawmakers calling for all PPP loans under $150,000 to automatically become grants, meaning owners would not have to go through the loan forgiveness process. Right now, loan recipients need to apply to have loans forgiven. Mnuchin also says he supports a second round of the PPP program, but it should be given based on revenue loss and the size of the business. A conservative group is instead calling for back-to-work bonuses for small businesses and employees, along with payroll tax cut. The government has approved nearly 5 million PPP loans for over $500 billion as of last week. There's still billions of dollars remaining in PPP funds and millions of applications waiting to be processed.
And up next, an experimental COVID-19 vaccine has shown positive results after its first round of human trials. Scientists hope to have at least 1 million doses ready by September. And the Commerce Department has blacklisted 11 more Chinese companies. Find out why after the break.
Hello there. Doesn't it feel like we're moving further away from the very values that our republic was built upon? And the media in our country has just been adding fuel to the flame, which is why you need to try the Epic Times. It's pure, honest journalism that's restoring traditional values, and it reports the news with no spin, no hidden agendas, and no false narratives. So if you want to know the truth about the FISA abuse that took place during the 2016 election, or how socialist and communist ideologies have been infiltrating our society, or how the Chinese Communist Party's cover-up led to this global outbreak, and so much more, then you need to check out the Epic Times. And for a limited time, you can try the paper yourself for a full month for just $1, and we'll send you a very special free gift. A giant timeline that's 3 feet by 4 feet, documenting the FBI's abuse of FISA spy warrants. So go to readepic.com and claim yours today.
When you look at TV networks in America, a soundbite and fight-it-out culture prevails on news and commentary programs. As a Canadian, I'm fascinated with America, and I wanted to offer American thought leaders an opportunity to share their thoughts in a deep dive format where we can explore their ideas together. And so American Thought Leaders was born. The world's most brilliant thinkers believed that open discourse was the key to greatness. However, all around the world, we see that discourse is being stifled and political agendas have subverted media. The Epoch Times launched its Global Thought Leaders program to bring back this great tradition of free thought. As the host of American Thought Leaders, every week I interview some of the most intriguing minds on the most pressing issues of our time. Be sure to check out our new episodes every week.
The European Union appears to be getting closer to finalizing a stimulus plan. It's been 4 days of planning already. The EU Council President is about to present leaders with a new proposal. Member states are split between those hit hardest by the outbreak who want to revive their economies and those who are more concerned about the cost of the recovery plan. The overall package is worth the equivalent of about $2 trillion. About $860 billion of it are lined up for the emergency stimulus package. Germany will contribute the most to the budget. Almost a third of the total has to go to low-carbon projects that are consistent with the Paris Agreement on climate change. And scientists at AstraZeneca and Oxford University have successfully completed the first human trials for an experimental COVID vaccine. The results seem positive.
AstraZeneca's experimental COVID-19 vaccine has shown promise in its early-stage human trials. It was found to be safe and produced an immune response in clinical testing in healthy volunteers, data showed on Monday, with the strongest response seen in people who received 2 doses. Director of the Jenner Institute at Oxford, Adrian Hill, hopes 1 million doses might be manufactured by September, but that early estimate might be an underestimate, depending on how quickly late-stage trials can be completed.
If we can get an effective vaccine, we will be able to vaccinate very large numbers of people because we can manufacture this vaccine at scale. And that will allow people to get back to normal life, hopefully, after they are vaccinated.
They have signed agreements with governments around the world to supply the vaccine, should it prove effective and gain regulatory approval. British Prime Minister Boris Johnson described the early-stage clinical trial data as very positive.
Pfizer and Germany's BioNTech also reported data from their experimental vaccine trial. The result shows that it was safe and prompted an immune response in patients. Another vaccine candidate by a Chinese company and China's military also showed immune response in their human trial. And Uber has launched a service to give health officials quick access to data useful in contact tracing. The data would let officials know which drivers and riders could have interacted with the virus carrier. The service is free and Uber is promoting it to public health officials in all countries where it operates. Officials can use it to access information on an individual in as little as a few hours. And global banks are screening clients in Hong Kong to see if they have pro-democracy ties. This comes after the Chinese regime's new national security law was enforced in the region. Clients who have showed support for the democracy movement in the past may find it difficult to access banking services.
International banks are investigating whether their clients in Hong Kong have ties to the pro-democracy movement. They want to avoid upsetting the Chinese Communist regime's new national security law that was just enforced in Hong Kong. Wealth managers at HSBC, Credit Suisse, and UBS are expanding scrutiny under their programs that screen clients for political and government ties. Clients designated politically exposed persons could find it difficult or even impossible to access banking services. The background check includes looking at clients' comments on social media and in public. According to Beijing, offenders of the new law can face up to life in prison. One banker says the audit of its clients can go back to 2014, the same year the pro-democracy umbrella movement took place in Hong Kong. Several elements of the new law deal with seizure of assets. Companies can also face penalties like fines and suspension to even the loss of business licenses. One hedge fund manager in Hong Kong says he expects more people to come under scrutiny from their bankers now.
The U.S. Commerce Department has added 11 more Chinese companies to an economic blacklist. The list is for companies and other entities involved in the repression of Uyghurs and other Muslim minorities in Western China. The department says the companies have used forced labor or supplied technology used for repression in the region. The latest blacklist additions include 2 firms that helped the Chinese regime use genetic analysis to persecute the groups. Blacklisted firms cannot buy components from U.S. companies without U.S. government approval. This is the 3rd round of additions to the blacklist. Earlier rounds cited 37 companies and other entities. And still to come, the biggest move in the U.S. energy sector since the pandemic. Chevron will buy Noble Energy in a $5 billion all-stock deal. And business owners are finding more creative ways to make customers feel safe. Find out what one restaurant in Texas is doing after the break. Chevron says it's buying oil and gas producer Noble Energy for about $5 billion in stocks. It's the first big energy deal since the virus sent crude prices to historic lows. Chevron has been shopping for assets since last year and now has taken advantage of a 30% plunge in crude prices to acquire high-quality assets. Chevron will have access to Noble's Leviathan field, the largest natural gas field in the eastern Mediterranean. This will provide the company with low-cost cash-generating assets. The deal will also add on to Chevron's U.S. assets. The deal values Noble at around $13 billion, including debt, and shares of the company jumped 8% in pre-market stocks. Business owners appear to be getting more and more creative with their ways of returning customers to feeling safe. We take a look at how one restaurant in Texas is doing exactly that, using their own unique approach, a sanitation station.
A breakfast restaurant in San Antonio, Texas has adopted a unique way to keep customers safe while they grab a bite to eat. As customers head into Alamo Biscuit, they pass under a disinfecting portal, and with the press of a button, they are sprayed with a quick mist of disinfectant.
We have installed a disinfecting portal. It's a portal or a device that my company distributes.
John Vale owns both the restaurant and the company that makes the disinfecting portals. He explained that the sanitation station sprays a chlorine-based, skin-safe mist that kills over 99% of germs. He says so far the feedback has been positive.
So far they're liking it. We have customers that are using it as they come in, and then they use it as they go out. So it's not just on entry.
He added that using the portal is optional but not required before guests enter the restaurant. But that added layer of protection may help some of them feel more comfortable while they enjoy their brisket, bacon, and of course, biscuits.
That's all the business updates for now. Thank you so much for tuning in. We'll see you again tomorrow.